Hello, good afternoon, everyone. Oliver Kolofsky here with Director of Wealth Services and Partner at Sweet Financial Partners. I hope you're having a good day and want to wish you a good afternoon. So today I'm going to share with you a few updates as it relates to the markets, and we prepared these slides like the middle of last week, so about this time a week ago, and there've been, of course, some new events that have happened kind of over the weekend or last Friday, so we added a couple slides to that, or as it relates to some of the banks and the global banking situation. So here's some disclosure here that this is not tax or legal advice. I'm not providing any investment recommendations throughout this time here today. So let's start with volatility. Let's look from a historical perspective. And we've shared this chart before. We've got some updates to it. So there's a lot of numbers here, so I'm going to break this down and then we'll zoom in on a few things. So if we look at, this is the annual return in each of these rectangles, whether it be blue or orange, that is going to be the annual return for the S&P 500 for a given calendar year. And it's broken out by ranges. So if we look at the first blue line, the blue upward stacking of bricks there on the left, it would be like 0 to 7%. That's when the S&P 500 for a calendar year was up 0 to 7%. And to define the S&P 500, we're going to break that down a little bit later, but the S&P 500 would be generally large cap US stocks. So 500 of the largest US stocks. So a couple things here to take away. One, this is going back 97 years. So we see here 71 years we've seen a positive return, and 26 years we have a negative return for the year. Now the average return for when the market is up, it's over 20%. It's 21.3%. The average for those negative years is 13.4%. If you look at the end, the left kind of tail and the right tail, if you will, let's look at the right first. So that's when the stock market was up over 28% for a given calendar year. And on the far left, that's the times calendar years when the stock market was down more than 28% in a year. The good news is there's only three occurrences where it's been down, 3 orange bricks there on the left, where there's been a lot more when the market is up, the last of which being 2021. So we're going to get to like average returns, but sometimes I hear people say, well, like the average return of the stock market is like 10%. And that's a very rough thing, depending on how far you go back. But you could say also the average temperature in Minnesota is something like 55 degrees. Well, yes, but rarely is it 55 degrees. It could be, of course, negative 15, or it could be into the 90s. So averages are just that, averages, but they're kind of find the middle ground because there are things on either tail, if you will. So now let's focus in on the green box here over on the left. So that's going to be times when the stock market was down 14% or more in a given year. And again, I'm using the S&P 500 index. So when we say the market, that's what I'm saying. There are certainly a lot of different markets, whether it be international stocks, large cap, small cap. But for this presentation here, we're going to use the S&P 500. So we see last year, 2022 in there. Yep, and we'll break that down a little more here as we go along. So last year down 18%. So the last 97 years, there's really only been 2 occurrences where the stock market in a calendar year has been down 14 to 21%. It was 1973 and 2022. The other takeaway from this slide, so there are 8 calendar years here. And again, this is 97 years of data. So 2022, as it relates to the stock market, one of the, call it seventh worst year for the stock market in the last 97 years. That's what we saw in 2022. And that's the stock market. We're going to get to the bond market. And the bond market will be a good segue to what's happening with banks, certain banks, I should say. Moving on, this is an interesting one. There's a lot of moving parts here, but I'll try to explain what it is. And this is as of, I think, the end of January. is when this was published. So this would be what your annualized returns were if you just invested in the S&P 500, if you started investing at the end of that particular year. So what this is saying is, if we look at, let's start at the one down item, if you would have started investing on 12/31/21, which would have been like the all-time high for the stock market or within a couple of days of it, and this is through January, the end of January 2023, like your average annual return would have been negative 12.5%. If you would have started investing at the end of 2020, your average annual return is 4.4%. So those who have maybe invested a lot of money in the last call it couple years, it's been a challenge as it relates to the stock market. Not coincidentally, if we look at this big difference right here from 08 and 09, that's when we saw a 50% decline from the high point of October of 07 to March of 09. So as someone started investing at the at the end of that time period, we've been buying it at a low point. That's why the average annual returns are pretty high there. So the point of this slide is, in general, for most years, when you start investing, you're going to have a similar type returns, but there are certainly some outliers there. So like the low point, 6.4 up until recently, 6.4, that would have been right before like 2000, 2001, and 2002. We had 3 consecutive down years. If we just started investing, then your average annual return over the last 23, 24 years would not be quite as high. So let's look at where we are for stocks and bonds more in the near term, let's say. So this is going to be 1 year. So the blue line, or excuse me, the purple line, again, is going to be the S&P 500 total return. In one moment here. All right, the S&P 500 total return is the purple line. So we can see over the last year, it's down about 4.5%. So we've seen kind of what some might term as a trading range. We've seen it go down, go up, go down, go up. And the net result is we're down about 4%. The low point here recently would have been the end of third quarter 2022, so last year. So that would have been right at the end of September. So we are up a decent amount off the low point for the market. At that point, from the starting to here, the low point of the purple, and that was down about 15%. And now we're showing us down about 4.48 from the starting point. So I want to add a little context there as to, sometimes given the volatility or, things on the news, it might be like, oh my gosh, we're like at a 1 year low or a 2 year low, and we're certainly not there. We're well off the lows. What's interesting, and we've got more slides on this, we'll talk a decent amount about this, is if we call that the orange line, the other line that is saying it's down 6%, 6.3%. That is like the US bond market, the total US bond market. So historically, stocks and bonds have been like a teeter-totter effect or a diversifier to one another. When one is up, maybe the other is flat. When one is down, maybe the other is up slightly. So what's happened over the last year or a little longer, with the inflation numbers really high and the Fed having to raise rates at a very rapid pace, it's been very impactful to bonds in a negative way. Bonds have kind of behaved or have behaved with the same volatility of stocks over the last, call it 12 months, 13 months. So rarely do you see something like this where had a person been all in stocks or all in bonds over the last year, the person would have actually performed better being all in stocks. So let's break this down a little more. Let's look at a longer time period here. This is essentially from the market high point. Not quite. This is like the 12/31 of 21 until now. The market high point, I think, was like January 3rd or something like the first trading day of 2022. And purple line is the S&P 500. So we're going to see from the market's all-time high at the end of 21 or very first day of 22, it's down about 16%. The bonds, again, would be orange. From the high point there, the same starting point, they would be down about 11 or 12%. Again, over the last 13, 14 months, whether you were really aggressive or fairly conservative, the outcomes have been pretty similar. Now, like the exception would be if you had energy stocks last year, and a few others, those did really well, like last year in 22. What you will see also is, and I think this will continue, is the bonds had the bottoming in fourth quarter 2022. They've kind of slowly worked the way back up into the right. I don't know if that'll continue, maybe slowly up into the right, but I don't think there's a lot more downside in bonds, but that's always subject to change. And we'll talk a little bit more about that when we look at inflation and possible interest rate adjustments here in a few moments. These two colors, if you will, would be year to date. And this doesn't include today. The market, the NASDAQ was up today. The S&P 500 was off a little bit, and the Dow was down a little more. But it definitely at one point was off a decent amount, but it kind of rallied towards the end of the day. But anyway, so the purple line, the US stocks are positive year to date, the S&P 500. Now, certain stocks aren't, like most bank stocks aren't positive for the year, but if we take the 500 stocks, a composite of the 500 stocks, it's up year to date, 2.46%. The orange line, again, the bonds, up 1.59%. So even with kind of some of the kind of crazy headlines in the last 4 or 5 days, the markets, stocks, and bonds, their aggregate indexes are positive for the year. So this one never really showed this chart before because it's never really changed until last year. So this is 47 years worth of data. And this is the Bloomberg US aggregate index. That was the orange line I've been showing on the prior 3 slides. The red dot for a calendar year is going to be the intra-year decline. The gray bar, either up or down, is going to be the calendar year return. So in the last 47 years, bonds have produced a positive return 42 of the 47 years. Meaning if we look at the horizontal line there, 42 of the gray lines are up, and 5 would be down. With the red dot being the intra-year decline. So a lot of years at one point, from high to low intra-year, there was some volatility, some downward movements. You'll see a lot of the red dots in that 2 to 5% range. But of course, we see the outlier in 2022. We see a 17% intra-year decline, almost double the prior highest of 9 back in the late 70s. We see the calendar year return of negative 13%, more than 4 times the largest. The largest was like 3% in the mid-90s. So we saw 13% for the year. So again, this chart never really changed up until last year, so we didn't have to, we never really showed it. So why this is happening, in large part due to inflation happening. So the Fed increasing interest rates, causing bond price volatilities. Generally speaking, bonds and interest rates move inversely of one another. As interest rates go up, bond prices go down. We'll keep that in mind, because as we get to the banking discussion, this is going to be part of, if we talk about like Silicon Valley Bank, what happened in Signature Bank, this 13% decline, and if it was longer term bonds, the prices would be even down more than 13%. So we're going to come back to this. So this is a key slide, and something that, as you can see, has never hasn't happened. The first time it's happened in 47 years. So this is a lot of colors here, but I'll take a few moments to explain it, because it's a very good slide. This goes back over 70 years. So this goes back to 1950. Back to 1950. And this is if someone had 60% in stocks, 40% in bonds. So if we take those few charts I was looking at, like back here, if you had 60% in the purple line and 40% in the orange line. That's what we're looking at here. And again, however the bar is ending up where that teal line is, that is the calendar year return. The green line is going to be the stock portion. Like, how did that 60% in stocks either contribute or hurt the overall return? And the gray portion is going to be bonds. How did bonds either help or hurt? So you're going to see a lot of times, like let's say in the early 2000s, where we saw the green down, meaning the stocks hurt, the gray line up, the bonds helped. They're diversifier, like the teeter-totter type effect. What we saw in 2022, we saw 16%. You know, if you had 60-40, it was down 16%. You see the green was down some of it, and the gray was down some of it. So it's not the worst 60-40 portfolio performance in history. 2008, it's kind of interesting. The portfolio was down more, but it was all due to the stocks. You can see the gray line is actually up. In 2008, bonds were up. So what was kind of, you know, weird is the right word, but like 2022 felt a lot like 2008 in terms of total returns, but the stock market wasn't down near, not even close to what it was from like the high in 07 to the low in 09. But why the portfolio could have felt like that, and it's not all clients on this call, so I can't speak exactly to the portfolios, but what we did in certain portfolios is very much lessen this interest rate exposure. What you would have seen in 2008 and 2022 is the outcome was pretty much the same, but how it got to that -16 or -20% return was very different. In one, it was a ton of stock market downside and a little bit of bond upside in 2008. 2022, it was a decent amount of stock market downside and a decent amount of bond downside. So yeah, it's really only happened. It was very unique, 2022. So why we put this in here is we still believe in diversification, even though like diversification didn't work as well last year as it historically had. If I'm getting in 2 elevators to go down, and one has 1 safety cable and one has, let's say, 3 safety cables, I'm still stepping in the elevator that has 3 safety cables. You know, still believe in diversification. Let's talk about inflation, switch gears a little bit. In reality, all this is related, but let's talk about inflation. So this goes back to 1980. $1 in 1980, 1 US dollar, worth at the end of 2022, 28 cents. So that would be inflation eating away at purchasing power. So if we look at the year-over-year change in inflation, that's going to be our blue line here. And our 3-year average is the orange dotted line. The January inflation was right at that 6.4 or 6.5. They just announced the February at 6%. So it's coming down. You know, inflation is coming down. But it's still nowhere near where it was or where the Fed says they want it to be, kind of in that 2 or 3% range, depending on how you read into their commentary. So naturally, the 3-year average is going to move more slowly up than the upwards than the year-over-year change. But we have seen started to see a decrease in inflation. The 9.1, that was the highest reading. That was in June of last year. Yeah, so it's down about 1/3 from its high point, according to the government statistics. So what we saw just recently, that was the slowest growth or the largest decrease since September of 21, based on the February number. So what is the Fed doing? Like what tools do they have in their toolbox to decrease inflation? Well, it's typically short-term interest rates. And they've been raising rates really fast. And that would be my next chart that's going to show them going really fast. But this year was kind of interesting. This is year over year. So December of 21 to December of 22, the price change of selected items, which comprise the CPI. So these are things, CPI, Consumer Price Index, that blue line on the last page, these are the things that comprise it. And one that jumps out a little bit is used cars. It's saying used cars down 8% in December of 22 relative to December 21. They're not surprisingly, we see food and energy or energy related items as the top items that are causing that inflation to be high. So there's the 6.4 number, then broken out by its components. I thought this was an interesting one that I wanted to share. So this is showing from peak inflation, like how historically a stock market performed from peak inflation. So our peak inflation, hopefully we don't get back there, was 9.1%. So on this chart, that's right here, it's the 9.1%, June of 22. So we look back to 1934, so 90-ish years or so, and we looked at the returns of stocks and bonds for the next 12 months. Only one time in history have stocks been negative, and never, and it's history, not that it's necessarily going to happen like that, but it's some context. We've never seen stocks. We've only seen stocks negative one time. That was in July of 2008. And we've never seen bonds, that'd be the right-hand column, never seen bonds negative over the next 12 months. So we're 8 months in. We're 8 months in from the peak. And we're at the stocks 6.1%. This is through the end of February. The stocks 6.1%. And bonds are off slightly. If we were to look at that like today, adding the 15 days of March, stocks wouldn't be up quite as much and bonds would be about the same. This really shows the change in interest rates in the last year. If you have the news on, you'll probably hear people say inverted yield curve. And that's what we have right now. I'm going to walk through. So down here on the x-axis going across the 1M, that's 1 month, 3M, 3 months, 6 months, and then the Y stands for a year. So down here going across horizontally, go from 1 month all the way to 30 year. And this is going to be government bonds. What does a government bond pay? Yep. So the blue line is 12/31/21. So if I would have bought a 30-year government bond on December 31st, of 2021, that would put me right here. I'm looking at the blue line, 30 years, just under 2%. It's going to pay me just under 2% for 30 years. And if I don't sell it for those 30 years, at the end of 30 years, I'll get my money back, however much I invested, and I'll get interest along the way. Again, 12/31/21, had I bought a 6-month government bond, it would have, that'd be right here, I bought a 6-month government bond on 12/31/21. It would have paid me like 0.25%, virtually nothing. And that's not an inverted yield curve. That's the blue line is how it was 12/31/21. That intuitively says if I invest for a longer term or I lock up my money for longer, ideally I would earn more interest. What's happened though since is if we look at the end of December 22, so that's the orange line, we've seen an inversion of that because the Fed has been raising short-term interest rates. Now, if someone would have bought a 6-month treasury on 12/30 of 2022, that's going to be right there. That's like 4.7% annualized. So a year ago, you would have bought it and it would have paid you 0.25. Now that's 4.7. That's a huge change. 30-year though, you go out to, if I buy a 30-year, it's just under 4%. Meaning I get paid more, larger interest if I invest for like 3 months or 6 months or a year relative if I invest for 30 years. And that is an inverted or a variation or a version of an inverted yield curve when the yields are higher on the short amount of time than they are on the long end or like 20 or 30 years. I mean, you can see from like right now or at the end of 22, whether you invest for 5 years or 30 years, the rate is the same. It's right around 4%. But that shows how much interest rates have changed in just 1 year. Like 6 month went from 0.25 to like 4.7. And again, that is when we get to talking about these the banks here shortly. This is a good part of it. So let's go there. Let's talk about, so there have been a couple bank failures, Silicon Valley Bank and Signature Bank in New York, that very much the same issue or same thing. So this is a chart out of the Wall Street Journal. There's a few takeaways on this chart. So it's going back to 2019, so it's a relatively short chart, and it's going up here to the end of 22. And this purple, the darker purple or deeper purple, that's uninsured deposits. So deposits at a bank are FDIC insured up to $250,000 per account titling. So that is uninsured. And then the kind of that bluish color is going to be insured. So that's those deposits that are covered, or were covered by FDIC under that $250,000 threshold. The first takeaway, massive increase in deposits from 2020 up to 2022. I mean, they were like 50 billion, just over 50 billion, and they peaked at 200 billion. So all those deposits coming on, the bank's got to do something with the money. They can lend it out, or they can buy for a portion of it. They're going to buy, some sort of portfolio of securities. Sometimes, treasury bonds, could be long bonds. So they did a lot of investing in bond treasuries in 2020 and 2021 when interest rates were really low. That's takeaway number one. Takeaway number two, there's a huge amount of uninsured deposits, which would lead one to believe that there are some companies or entities or people with some really, really large balances in that account. It's not like a bunch of people with 300,000. So you've got a bunch of people that are just $50,000 over, or a bunch of companies. But it'd be very hard to have the chart look like this if that was the case. There's a company called Roku, the streaming service, like, I don't remember what the number was, something like $100 million. So there are some very large entities, generally tech firms, we'll show that on the next slide, that have some very, very large cash deposits, or people with some very large cash deposits at the bank, because there's such a large amount of uninsured. Same thing with Signature. I think the insured amount, yeah, you can see a solo Signature Bank was very similar. So what happened is those folks are seeing what's happening here and knowing that, gee, if that bank bought bonds in 2020, 2021, they're buying them on this blue curve. We're seeing interest rates go up, bond prices are going down. That doesn't look real good on the bank's balance sheet. So because you've got a few really, really large depositors, when those folks leave the bank, move their deposits because they get a little nervous about the bank's health, it doesn't take a whole lot of depositors to move hundreds of millions of dollars for the bank like this to start to get in trouble, because they're having to then sell those bonds that if they held them for 20 or 30 years out to maturity, they'd be fine. But now they're having to sell them when they're down, in that one chart, I think we showed for the year, like 17% or 14%. So they're having to book those losses to fund redemptions. And then the rumblings get out that people are starting to move money and they're having to sell bonds. And then you get a few of these really big depositors that move out, and that becomes the end, because they have such a huge portion are uninsured deposits, and the bank can't fund deposits, or can't fund redemptions, excuse me. So here is what their deposit funding was. This is like when they had 177 billion. That would have been like when they were right in, here towards the end. You can see, as the name of the bank, Silicon Valley Bank, a lot of it, 50% there, is tech companies, early stage technology, a very different deposit base than you might see at other banks. So Silicon Valley Bank seems very different, like than a local bank here, which probably, if you look at the average balance in these accounts, it was huge. Probably, I guess I can't speak because I don't have data to a local bank, let's say, with a few branches, but nowhere near the average deposit that you would see in something like this. Got a question here. Yeah, about Charles Schwab. Charles Schwab has been in the news a little bit. So Charles Schwab is a publicly traded company on the stock market. And for those of you who are clients of the firm on here, you're likely familiar with Raymond James. That's where Sweet Financial Partners was aligned with Raymond James for a very long time. And now assets that are custodied with, for the most part, with Charles Schwab. So Raymond James is much, much smaller than Charles Schwab. And Raymond James has the same client protection provisions as Charles Schwab, or I could say it the other way, Charles Schwab has the same client protection provisions. And if you would look at like Raymond James's stock versus Charles Schwab's stock, Schwab's down more, but all of the firms, or I shouldn't say all, but most of them have had a stock price decline. The reason Schwab gets the headlines is because it's much bigger than Raymond James, and many more people have accounts at Charles Schwab than Raymond James. If they published an article about Raymond James, frankly, not a lot of people are going to click on it. If they publish an article with Charles Schwab in the headlines, it's probably going to get more clicks, and you can subsequently sell more advertising. The stock price rebounded yesterday like 12%, and the stock market was down a little bit today, but Charles Schwab was up again today. So very much, like we were with Raymond James, very much comfortable with Charles Schwab. And again, there are government backstops in place, just like FDIC, only it's called SIPC on the securities side of things. So this would be again, the deposit portfolio for Silicon Valley Bank. Signature Bank, same thing, in terms of a very large percentage of uninsured deposits. You got some big people or big depositors take money out. They have to sell bonds that are down a decent amount, and then it becomes a domino effect. So there was a thing earlier about the 250,000 on government insurance. So what happened over the weekend? So this happened on Friday. A lot of chatter over the weekend is what's going to happen to these uninsured deposits. So as it turned out, the government stepped in and backed all of the uninsured deposits. They ended up being insured. So one could there's a lot of ways to look at that. One could make the case that was a positive thing, because had they not done that, there would have been a lot of money, a really, really high amount of money moving on Monday morning out of mainly regional banks for uninsured deposits. Money is going to be moving between different banks. And to fund those redemptions, each bank is going to have to do that, how they have their policies and procedures and investment portfolios set up to fund that. But one could make the case that had they not done that, it was going to be quite the frenzy, if you will, come Monday morning, with money moving between a lot of different banks, given the amount of uninsured deposits that are out there at banks. As we, a little quiz for you here. Have a little fun. I think it'd be fun. Maybe not fun, but interesting maybe is the better word. So we've talked a lot about the S&P 500. So it's 500 stocks, but it's not 1/500th in every stock. It's what they call market cap weighted, meaning the large companies are much more than 1/500th of the index. So think, and I'll reveal the answer in a moment, but if you think back, what were like the top 5 companies from the S&P 500 on December 31st, 1999? So if you want to think back, I'll give you a moment. I'll give you a clue. It wasn't like Facebook or Google or Amazon, but I'm going to share a chart at the end of why this is at least good to be aware of. So there it is. Those were the top 5 stocks. So Microsoft, GE, Cisco, Walmart, and ExxonMobil. The other thing you want to note here is if you look to the right, it's going to say what percentage of the S&P 500. So the largest component of the S&P 500, Microsoft, under 5%. Under 5% on 12/31 of 99. 12/30. We don't put 12/31 because I think that was like a Saturday. So the last trading day of the year was 12/30 of 2022. What were the top 5 companies in the S&P 500 12/30/2022? So I'll give you a hint. It's not the same 5 companies. All right. There it is. One company the same, Microsoft. The interesting thing is, let's look where the largest company is and where the, shouldn't tell you the smallest, the fifth largest is. So the largest is at over 6%. The fifth largest is at 1.73. So 6 to 1.73, that's our divergence, if you will. So here it's 4.89 to 2.26. So you can see it's become, a little wider. Mainly what you would call technology type companies. Berkshire is, of course, Warren Buffett, and very, very diversified. But here's I guess the point of this, if you will. Again, a lot of numbers here. I don't know if there's kind of a point to it. So let's first look at the orange line. If I look at those stocks, so the orange line is going to be Cisco, GE, Walmart, Microsoft, and ExxonMobil. What percentage of those five as a proportion or a portion of the S&P 500? So go back to 1985, it was 5%. At its peak, it was 17%. And that's when they were the top five, 12, 31, 99. And now it's like 8%. Those five make up 8% of the S&P 500. Now let's look at the blue line. So the blue line's Apple, Amazon, Google, Microsoft, and it says Tesla there, which I thought it was Berkshire Hathaway, but anyway, the technology stock. So the interesting thing is they had no value up until like mid-1994. They weren't a thing, or very little. It would have been a little bit of an Apple, a little bit of Microsoft. So we can see those that call it, for all intents and purposes, like zero. By the height of mid 2021, we're 24% of the S&P 500. So when you say, well, the S&P 500, that's 500 stocks, well, it is, but in reality, there's 5 stocks that are moving 25% of the S&P 500. So it gets very top heavy and dominated by those names. So when you see movements in the stock market, be a little careful that it's not always 500 stocks moving that direction. It's sometimes a select few. And now with technology stocks, struggling in 2021, they've rebounded a decent amount, or some, in 2022. That 24% high point is now back down to 19. So it's now about where the high point for those 5 were in 1999, the Cisco, GE, Walmart, Microsoft, and ExxonMobil. So that's why sometimes people will say, well, gee, I should put all my money in the S&P 500. Well, one could make that case, and it's generally prudent to have some money in the S&P 500 or exposure there. But at times you can get fairly concentrated, even though it sounds like you have 500 stocks. This is going to speak a little bit to tax efficiency. This is going to be for non-IRA accounts. I won't spend too much time on this one. The orange bars are going to be what's called capital gain distributions. And you'll see the orange lines are mutual funds, and they're always, in that like 70 to 90% distributing a lot of capital gains, meaning they're not very tax efficient. So if you're in certain portfolios of Sweet Financial, we much more right now use the blue investments, the ETFs, or exchange traded funds. Not exclusively, but we certainly have a larger exposure to that than we have historically. The blue line, you want the line on this chart to be low, and that's what we're seeing with ETFs, or exchange traded funds. A couple other general comments on the portfolio, and this is going to be based on it. Well, 1, if you're a client, and 2, if you your risk level, your cash flow. You generally, we've seen small cap stocks go down a lot the last month. We made some changes at the end of January. There's a good chance you don't have any small cap stocks right now. If you have the 25 stock portfolio, there are no banking stocks in that. We haven't had any this year. So it's been good that hasn't been the case. So we've been proactive on that. So a couple of comments on the portfolio. I have to be really, really general on those with these, with this type of forum. All right, I got some good news as we close. I guess I'm like 1 minute over time, but I'll keep you a little longer if that's okay. I'm going to transition a little bit out of the market. So view the markets as kind of like the weather. Like you can't control the weather. But if you know it's going to snow, you can, have your snowblower ready, or you can have a hat and gloves ready if it's going to be cold. If you're going out in the sun, you can have sunglasses or sunscreen. You can't control the weather, but there are things you and I do control. So I just want to quickly run through these again as a reminder of things we're doing for you. How to save, pre-tax versus after tax, from which account to take income, and when you start Social Security income, how much income you take, how to give to charity, spendable income versus taxable income, how much to save, how much to spend, how and when to make large purchases, cash versus debt, healthcare expenses. If you're under age 65, you got to take income from certain accounts to qualify for tax credits under the Affordable Care Act. So all of those items, I rattle them off really fast because I'm over time, but all of those items are 100% you and I control those. We don't control the ups and downs of the markets. We can control risk to a certain extent in the portfolio, but we do spend a lot of time in our conversations here focusing on those items that you and I have a lot of control over, or a good amount of control over. Roth conversions, we've gone through these before, why it makes sense. So I won't take any more time on that. I'll leave a little more time for questions here. So there's my email address, oliver@sweetfinancial.com. That does come directly to me. Those emails come directly to me, and I will reply. Yeah, I'm not seeing any more. So as always, any questions, always feel free to call or email. You're never bothering us. That's what we're here for. We thank you for your continued trust and confidence, and wish you a wonderful evening. Thank you.